Hello everybody, Daniel Evans here. What we're going to do now is we're going to discuss monetary policy and how it's linked to the banking system. We've already spoken about the banking system in a previous video. Now we're going to take this forward and look particularly at how the banking system executes monetary policy, and we'll also look at the role of the central bank and the central banking system in developed economies. So sit back, relax, and let's discover a little bit about monetary policy. Okay, so we've already discussed macroeconomic policy, and just to remind everybody where we are, we mentioned in a previous video the challenges of fiscal policy, and remember this: the idea here is to draw out aggregate demand when we're in a recessionary gap. So here we have output or production that's lower than potential, meaning we have unemployment, and one way we can solve this problem is by expanding the economy. And fiscal policy did this through, for example, government expenditures, which was one opportunity here, or taxes. Now, monetary policy can also help us draw demand forward or pull it back if we're going too far, or contract the economy. But in this case here, we want to expand the economy and move it forward. To expand output. So monetary policy is all about the use of money and ways we control the amount of money in the economy to impact indirectly aggregate demand. And so let's take a look and see how that works. First off, we have to have a good understanding of what the central bank is and what it does. So the central bank basically is the organization responsible for conducting monetary policy and ensuring the nation's financial system operates smoothly. That's the role of the central bank. Now, we have a lot of central banking systems across the world today. We have obviously the Fed in the United States, but we also have other types of central banks. In Europe, we have the European Central Bank, the ECB. We have the Bank of Japan, the Bank of England, and there are obviously others out there, but these are the largest central banks that exist. We also have to know that in the United States, we refer to this sometimes as the Federal Reserve. That's the name of it, but it's for short. We'll use the word the Fed to represent the Federal Reserve. So what is the Fed and how does it work? So we'll focus a little bit in this video on the U.S. Federal Reserve as an example. I'll explain later on how the ECB is very similar to the Fed, and yet there's a very unique difference for the ECB than the Fed, and we'll see this. So the Fed is the central bank of the United States. It's composed of a board of governors. These are 7 persons that have been designated by the President of the United States. They serve, each of them serves a 14-year single term in most cases. Their term expires the 31st of January every even-numbered years. They are independent. They're protected from political pressure, and sometimes we even see the President of the United States going against or upset with the Fed. They're very independent, although they hopefully are working together towards improving the economy. They act then independently of Congress. The current chair of the Fed in the United States, and we're in 2020, is Jerome Powell. He is an equal member of the board. He has 1 vote. But, and this is very important, the power that the chairman has is that the chairman or chairperson controls the agenda, what is discussed. And this is an incredible source of power. This person can say, well, today we'll vote on this, or we won't vote on this, and that's their key source of power. So the Fed chairman has the same vote as everybody, but fixes the agenda. Now, the Fed is also composed of regional banks. And there are 12 regional banks in the Fed. As we'll see in the case of Europe, we have the national banks in Europe. Well, the United States is very large, and they have these regional banks. These regional banks support the commercial banks, okay, in their region, and hopefully help the economy in their region. And they advise the board of the Fed, these regional reserve banks. Now, what's interesting about these regional reserve banks is that each of these banks has a board of directors, and they choose a president. And these people are all named by the private sector. So the private sector appointed the president or appoint the president of the of these regional reserve banks. So it's interesting that the Fed is composed of, on one side, the elements that are appointed by the President of the United States, very politically, or they're done by politicians. And here we have the private sector side of the Fed that comes out. Now the Fed, as I said, is divided into 12 regional banks. And these regional banks, there's 12 of them. You see them all here. We have number 12, 11, 10, 9, 8, 7, 6, 1 is over here. Now, if you've ever looked at a $1 bill, you can actually see that this bill has been distributed by one of these regional banks, and their job is to help manage the amount of money that's in circulation. This one was emitted by Reserve Bank 12. So this is the San Francisco office of the Federal Reserve. This is the regional bank of the Federal Reserve in San Francisco, and you can see there's 12 of them. The Federal Reserve seal is here, but the letter L also represents that it came from San Francisco. We have here the seal of the Treasury. This is the seal of the Federal Reserve, and the number here indicates, as well as the code, the bank where it came from. Now, these banks, these regional banks, existed years ago also to help clear checks. If you wrote a check, for example, imagine you live here in Dallas, you live in your house, and you write a check and you send it to a company that's in San Francisco. Well, the bank first goes through the Dallas branch. It's routed then to San Francisco, and then the monies are transferred between these regional banks. Today, this idea of routing checks around different regional banks is less of a concern. It still exists, but the banking and the monetary system has evolved substantially since then. So, these regional banks obviously then manage the distribution of money. Oh, and I wanted to bring out something here very important, or if you're interested in knowing, is that the money is not printed by these regional banks. The amount of money, the money that's actually exists in the U.S. economy is minted or printed by the U.S. Treasury. It's distributed by the regional banks. They don't do any of the printing of the money themselves. So what does the central bank do? Well, first off, it conducts monetary policy. And this is what we'll get to in a few moments, is this idea of saying we're going to control the amount of money in circulation in the economy to either expand or contract aggregate demand to help us manage economic system. This amount of money is currency, and we've spoken about M1 and M2, and we have to moderate the amount of money. Sometimes in the economy we have a high need for money. We need to have more cash circulating in the hands when people are buying a lot of things. And so we often find that during Christmas times, during the holiday season, the amount of money in circulation actually increases. The central bank will expand during the holiday season and then retract the amount of money circulating when we come out of the holiday season. The objective also of the central bank is to promote stability of the financial system. Okay, so we want to make sure that everybody trusts the financial system, that it's stable, that people are not investing money in unsafe investments. And the central bank provides banking services to commercial banks and other depository institutions and the federal government. They are the bank of banks. The Federal Reserve serves as a bank for other banks. They also serve as a bank for the federal government, and of course they process checks. So a bank, a commercial bank here, can borrow money from the Fed via what we call the discount window. They go to the Fed, and a commercial bank can say, I need some money, or I'd like to have some money, and they'll borrow it through a discount window. We call it a discount window because usually the interest rates are discounted. They're lower than what we see in the marketplace. So the Fed has many roles to play. One of these roles, as we mentioned, is banking regulation. This there to promote stability of the system, obviously. We also have regulations that aim to maintain solvency, to make sure that they have money on hand if people want their money, and that's what we refer to as solvency. This is through required reserves, so banks have to maintain a minimum amount of cash to cover demand deposits. Certain capital requirements, so the net worth, so banks need to maintain a positive net worth, and that's part of the regulation. And also restrictions on the type of investments that banks can undertake. Banks can't just invest in high risk areas, and how banks can invest the cash and the money they have is determined by the Fed. And reserves that are on hand, these required reserves that the Fed will impose, it should be noted that these reserves are not in the bank. So if you go to a bank today, a local bank, and say, let me see your required reserves, they usually don't have them there. These required reserves are held in the in the bank account at the Fed. As I said, the Fed is the bank for the banks, and the reserves are with the Fed in the Federal Reserve. And these are called federal funds. The federal funds are the money that, if I have a bank here, and this is my bank, and here's my bank, and here's the Fed, okay, and the Fed says, well, you need to maintain, let's say, $100 million in reserves. I'm not going to keep the $100 million over here. I'm going to keep it in a checking account with the Federal Reserve. And if I need it, well, you can send it to me. And so they're called federal funds. Now we do this idea of regulating the system to avoid financial collapse and avoid, in particular, runs on banks. When people run to the bank and say, I want my money. And this almost happened. We saw it coming close to a severe bank run in Greece in 2015 when the financial system started to collapse and banks shuttered their doors. They shut the doors and told people to go away. How do we ensure? How do we make sure that the bank runs don't happen? Well, there's two ways we can do this. One is that the Federal Reserve, the central bank, serves a role in providing and helping to provide money. And the second is this FDIC, the Federal Deposit Insurance Corporation. So deposits in banks are insured through the banking system to a certain amount of deposits. So if you go to the United States and you have money on deposits, it's insured up to $250,000 per account. And we have the same thing in Europe today, and in European countries, we have a certain limit that's insured. If something happens to the bank, we know that we can get a maximum out of the bank if there's a problem. And this provides us with some sense of security. It was established in 1930 in the United States, the FDIC, and since that time, no one's lost any insured deposits in a commercial bank. Now, the Fed also helps avoid bank runs, because imagine, you've got a bank over here and people are running and say, I want my money, I want my money. Well, that bank can turn to the central bank as what we'll call a lender of last resort. So, this is the last chance I've got. Oops. So the lender of last resort is the Fed, and the Fed can provide money to banks when they can't find money elsewhere. And this helps reassure customers. Now, the European Central Bank, as I mentioned, is very much like the Federal Reserve in the United States. It has a board of governors, and it has members that are the governors of the national central banks. This board conducts monetary policy, and it includes the governing council includes the executive board. There are 19 national central banks. They're like the 12 regional reserve banks for the Fed. And the tasks of the European Central Bank, you've got them right here, to define and implement common monetary policy, to conduct foreign exchange operations, so they can buy and sell foreign currency to change the exchange rate. They hold and manage foreign reserves and official reserves, and to promote the smooth operation of payment systems. Now, and this is an important point, the European Central Bank has a very narrow objective, and I've listed this right here. The European Central Bank basically has a primary goal of maintaining price stability, having low inflation, around 2%. Okay, so this is what's called inflation targeting. This is not the case for the Fed. The Fed in the United States looks at inflation. They're concerned about inflation. So yeah, the Fed will say, yeah, I'm interested about inflation. But they're also interested in unemployment. So they'll look at unemployment, they'll look at growth in the economy, and many other things. So the Fed is focused on many economic indicators and making sure the economy is growing appropriately, making sure there's low unemployment, whereas the European Central Bank focuses primarily, if not uniquely, on inflation. So they target inflation. This is called inflation targeting. And this is one of the main differences between the Fed and the European Central Bank. So central banking and central banks have various tools at their disposal to undertake monetary policy. In the case of the Central Bank of Europe, to control inflation, and in the case of the Fed in the United States, to expand output and to decrease unemployment and whatnot. Now, these three traditional tools are the following. The first is what we call open market operations, and we'll see what this is in a minute. And for the Fed, these are decided by what we call the Open Market Committee. It's the board plus the 12 Reserve Bank presidents. They work together to define this open market operation. We also have reserve requirements. We mentioned what reserve requirements are. So the banks need to maintain a certain amount of money on hand to cover demand deposits, and those are reserve requirements, and a little thing called the discount rate. So let's take a look and see what all these are. First, let's take a look at open market operations, and we start with a bank in this situation. So we have our central bank over here, and we have a bunch of commercial banks over here. And in the bank's balance sheet, what do we see? We see a series of assets. These assets could include, for example, bonds. So here the bank has invested in government securities, government bonds, and these pieces of paper, basically the bank gave money to the central bank. In exchange, the central bank gave them these pieces of money. These are investments, and they earn a very good rate of interest, probably a very guaranteed rate of interest. They're giving money to the central bank, and the central bank is giving them a piece of paper called a bond. And because the central bank has their money, they're going to give them the commercial bank interest for their money that they have. Secondly, commercial banks have reserves on hand and cash on hand. Some of these reserves are required reserves. We have them here. We can't touch them because we have checking accounts and we need to make sure we have money for our customers. Some of them are excess reserves, we call that, or excess cash on hand, and I can loan that out, I can keep it, I can do what I want with it. And lastly, banks have made loans to businesses. So they've taken money they've got, typically excess reserves, and they've loaned it out to businesses and households. And if they loan the money, they get the interest later on that these households and businesses will give them. So banks have given money to the central bank. In exchange, they get a piece of paper called a bond, and that pays interest to these commercial banks. Secondly, they have cash. They have required reserves and excess reserves. And they also loan money out. In exchange, they get interest payments from investors and people that have borrowed money to buy a car or something like that. And I want to bring out here also in our diagram, we've got the market for loanable funds. The supply of loans can come from banks, but from other places as well. And this is the demand for money. People want to borrow money, and we have the demand as interest rates decrease here, we see that the quantity, obviously, demanded of loanable funds increases, and we're currently in equilibrium. So let's take a look at and see how open market operations work. So we're going to consider the case of an expansionary policy, and to expand the economy, we're going to see that the Fed will buy back bonds from banks. Remember, these are these pieces of paper that they have. The central bank has their money, and this is a promise to earn interest for giving the central bank its money. And these banks have these pieces of paper sitting around. It's called a bond. So how does this happen? So the central bank basically makes an announcement and says, I'd like to buy back the bonds for you at a good price. So I know I can earn a certain interest on the bond. The central bank's going to pay me the interest, but now they're offering me to buy these back from me at probably a better price. And so because banks want to make profit, they're going to say, okay, I'm going to sell you back one of my bonds. So they give back the piece of paper. And in exchange, the central bank gives them their money back, plus probably a nice sum of interest to boot. So they're buying back the bond, and this money then arrives in the bank. So the money arrives in the bank in the form of reserves, and the bank can loan this money out because it's met its required reserves. It can't touch these reserves here, but now suddenly I have extra reserves. And as a result, the supply of money that can be loaned in the money market increases. And this basically results in a decrease of interest rates, and the quantity of loanable funds will increase. So interest rates fall as, well, the banks have got all this money. How will the bank get people to borrow this money? And, well, they're going to lower the interest rates to attract people to come and borrow that money. And we all know what low interest rates mean. Low interest rates basically increase consumption and increase investment by government, by businesses. So these lower interest rates will push up two very important components of aggregate demand: consumption by households and investment by businesses. And so we see demand increase, and we can see here that we've moved up to this different point, the new equilibrium, where prices are actually higher than they were before. But we've increased GDP. We've increased the equilibrium GDP. That's expansionary monetary policy with an open market operation of buying back bonds from banks. Now, what about contractionary policy? Sometimes we want to contract the economy. Well, we're going to do the exact opposite. In this case, the central bank says, hey, I'll sell you a bond with a great interest. Okay, so hey, I'll give you a nice interest rate. I want to sell you a bond. And the bank here has, well, we get some cash sitting around. Let's buy the bond. So the money flows back to the central bank, and they recuperate a piece of paper in the form of a bond. But, well, let's take a look at the amount of money. Suddenly, I don't have as much reserves on hand to make loans. I can't make loans. And so the supply of money available to be loaned out decreases. And as the supply of money to be loaned out decreases, well, the interest rate rises. And we finish our story. Because interest rates have gone up, well, aggregate demand is now going to decrease. Because interest rates are higher, investment will decrease, and consumption or borrowing to consume will also decrease. And so we see a decrease in aggregate demand, pushing prices down and pulling GDP back. So those are the two types of open market operations, and they typically involve the buying and selling of bonds to commercial banks. Now, the second tool of monetary policy are these required reserves. Remember that these are this is an amount of money that banks, commercial banks, need to keep for their depositors. If a depositor comes to the bank and says, I want my money, well, you got to have some on hand. And I told you before that this money is not really at this bank. It's saved over here in the central bank in their bank account with the central bank. So what happens if the central bank says, hey, you don't need to hold this amount of money, maybe you can hold less. And so the central bank, changes the required reserve ratio. They can raise the required reserve ratio, and this will decrease supply. So we're in a situation where we have required reserves. Now let's look at expansionary policy. If the central bank says you do not need to keep as many reserves, you can have fewer reserves on hand, then this money here becomes available to be loaned out. And as this money becomes available to be loaned out, the supply of money increases to be loaned out, the amount of money that can be loaned, and interest rates drop. And again, as interest rates drop, investment increases, people borrow money to consume, and this increases demand. We can do the exact opposite. We can increase the required reserve ratio, and that contracts the amount of money available. We move backwards to a higher rate of interest. So those are expansionary and contractionary policies using required reserve. Also, just remember that the federal funds are there. That money that are requiring for people to have is stored in the central bank. It's rarely stored on site in the banks. Banks, if they need money to meet their required reserve ratios, can borrow that from other banks. And so you can imagine, the Federal Reserve has all these accounts, and there's some federal funds from one bank in an account, another in another account. And if the Fed, let's say, raises the required reserve ratio, a bank may be in need of money to meet its required reserve ratio, and it can borrow the federal funds that one bank has if maybe one bank has too much reserves, and they pay an interest rate, and that's called the federal funds rate. And this is literally done evening to evening. So the last policy that does exist is using what we call the discount window. So the central bank is here. It has money. It can print money. It can make money available. And they have a window, a teller. And this window is there to serve the needs of commercial banks. And so the central bank can loan money to commercial banks at what we call the discount rate. And that's the interest rate that banks will pay. And it's quite simple exercise. The discount rate, the discount window is here. And the central bank basically announces, hey, you know what? I'm going to lower the rate. I'm ready to loan money at a low rate. Do you want to borrow some money? And the banks can say, yeah, sure, I'll borrow some money, because then I can loan it out to consumers and businesses at a higher rate. I'll make some money. So they borrow money at a low rate from the Federal Reserve or the central bank through the discount window. And as a result, what happens? The supply of money in the economy available to be loaned out increases and rates fall. And we know what happens there is that as rates fall, well, investment increases and consumption increases. People borrow more money. So we can lower the discount rate. Now, this type of policy using the discount rate is rarely used anymore. The primary type of monetary policy that exists today in the economy is principally open market operations. So what are some of the challenges of monetary policy? So we've seen open market operations, we've seen required reserve ratio changes, we've seen the discount window. And as I said, the discount window is not used as a lot in modern economies. So what are some of the challenges we've got with these different types of monetary policies? Well, some difficulties or challenges. The first would be that, as you've seen, all of this is very indirect. The central bank, let's say, does an open market operation. They push more money into the economy. the amount of loanable funds increases, the interest rates fall. As interest rates fall, investment increases, consumption increases. All this is a chain of events that takes time, and it doesn't happen overnight. So monetary policy can take time to have an impact. Secondly, banks may hold excess reserves. Banks choose how much they hold in reserves. That's part of how they manage their bank. And some banks are maybe more cautious than other banks. So even though the central bank says, oh, you have to keep 2% in required reserves, maybe they keep 5 or 10%. This is their choice. And so if the central bank says, okay, we're going to expand the money supply. Imagine they do an open market operation, so banks have more money. That doesn't mean that the bank's going to loan it out. The bank can keep the money in form of cash. And so we don't really know, central banks really don't know the efficiency or the effectiveness of their expansionary policy. Now this is a concern primarily for expansionary policy. It's not a concern for contractionary policy. But if banks hold excess reserves and we have cautious banks, well, the Fed may say, hey, let's expand the economy. And hey, it doesn't work. And the last thing I want to talk about, that's some of the difficulties, it's what's called management of velocity of money. And I want to explain this through a very simple example of what is velocity. So velocity of money looks at how often a dollar note or a euro note, if that existed, circulates in an economy in a given period of time. Let's take a look at a very simple example. Here we've got a euro note that exists. And this person has the note, and they're going to exchange it with this person in exchange for 2 apples that cost 50 cents. The person then that receives the note during this period of time is going to, at some point, exchange that euro note for, let's say, 1 hour of babysitting. So it's exchanged again, and the person receives 1 hour of babysitting, and they give the euro note in exchange for the babysitting. The babysitter is going to take the euro note and maybe buy some bread. Well, the price of a loaf of bread is 2 euros, so they're going to buy half a loaf of bread. And they give the euro note to the baker. The baker then takes the euro note and goes to the movies. So they give the movie cinema 1 euro in exchange for a low-cost cinema movie of 1 euro. So this euro bill over this 1 year period of time has changed hands 4 times. And that's the velocity of money. That's the velocity of the average euro bill, let's say. Now, this helps us understand something extremely important called the basic quantity equation of money. We know that we have 1 euro bill in this economy. So the money supply in this example is just 1 euro. To be able to buy all this stuff, the money had to change hands 4 times. So the velocity of money is 4. And it would change hands so we could spend money or expenditures. And expenditures or consumption in this case is GDP. So the nominal GDP is the value of goods and services purchased. And we can see what the value of goods and services purchased is in this very simple example. It's the price of apples times the quantity of apples, right? 2 apples at 50 cents each. It's the price of babysitting times the quantity of babysitting. Well, 1 hour at 1 euro per hour. It's the price of bread times the quantity of bread purchased. I bought, the price of bread is 2, so I bought 1/2 a loaf with the 1 euro I had. And the price of a movie times the quantity of movies. Well, here the price of a movie is 1, and I bought 1. The total amount expended, this is pretty obvious in this example, is also just $4 or 4 euros. So the equation tells us the following. It tells us that the money supply has to circulate enough to pay for the amount of goods and services purchased, or nominal GDP. Nominal GDP, however, is the price level times real GDP, or production. And if we insert that into our equation, we get that money supply times velocity is equal to the price level times real GDP, or M times V equals P times Q. So the challenge with monetary policy is making sure that as we increase the amount of money, it allows us to make the expenditures we want to expend. So why is velocity important for monetary policy? If velocity is not predictable, if it varies and is unstable, we have a hard time managing the amount of money in the economy. We need to make sure the money is there to permit people to buy the goods and services they want. But if velocity is 4, and then one day it's 2, and then one day it's 6, and then one day it's 4, then we have a hard time managing the money in the economy. So unpredictable movements or changes of velocity can limit the effectiveness of monetary policy. When velocity is stable, we like to have a growth of money supply also to be stable. But if velocity is changing a lot, then money supply is going to have to respond to these changes, and that makes monetary policy very, very difficult. So we've covered the basics of monetary policy. We've gone through the 3 principal ways a central bank can modify the amount of money in the economy and thus also impact aggregate demand. And we've said a few words as well about velocity of money and difficulties of monetary policy. So I hope that was relatively clear for you. If you have questions, don't hesitate to contact me, and I'll try to answer your questions as quickly as possible. Have a great day.